Happy Monday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. Just a reminder, later this week I will be in Tokyo. For those who are in or near Tokyo and would like to attend one of our subscriber meetups, either on Friday or Saturday, please send me an email. The address is in the description below. For those who have already sent emails, thank you. I will get back to you with details in the coming days. Today's video also has this month's sponsored feature. I'm particularly excited about this company. I'm looking forward to presenting it to you all later in the video, but for now, let's jump in with the first development. Beijing is quietly reshaping its vast foreign exchange reserves as political tensions with Washington intensify, moving away from its long-standing dependence on US Treasuries toward alternative dollar assets, gold, and non-US holdings. At the heart of this shift is China's State Administration of Foreign Exchange, SAFE, which manages the country's $3.2 trillion reserves. The reevaluation was sparked earlier this year when the Trump administration overhauled the boards of US mortgage giants Fannie Mae and Freddie Mac. Chinese officials, intrigued by the possibility of mortgage-backed securities as substitutes for treasuries, initiated an in-depth review. While US government bonds have traditionally underpinned China's reserves due to their safety and liquidity, recent developments including trade tensions, rising tariffs, and concerns over the weaponization of financial markets have prompted a reassessment. SAFE has already trimmed its official Treasury holdings by over 27% between January 2022 and December 2024, far outpacing earlier reductions. A central concern in Beijing is the potential for US sanctions or asset freezes, particularly after Washington's move to freeze Russian reserves following the 2022 Ukraine invasion. The incident reinforced the risks of relying heavily on dollar-denominated assets in an era of strategic rivalry. To reduce exposure, China has increased its holdings of agency bonds like those issued by Fannie Mae and Freddie Mac, which offer comparable credit quality with slightly higher yields, and has shortened the duration of its US holdings. SAFE is also boosting allocations to gold, which now represent about 6% of reserves, up from 2% just a few years ago. Private market exposure through vehicles like Rosewood Investment Corp is also being scaled back, especially in sensitive sectors like US technology. Meanwhile, SAFE is quietly shifting reserve management to non-Western jurisdictions, including a significant planned expansion in Hong Kong. Yet China faces practical constraints. No other sovereign bond market offers the size or liquidity of treasuries. Experts warn that a rapid divestment could disrupt markets and diminish returns. As such, SAFE's strategy has been one of agile maneuvering, balancing liquidity, safety, and returns amid geopolitical volatility. For now, officials in both Washington and Beijing downplay fears of a financial clash. Still, the mere possibility of China weaponizing its treasury holdings is prompting global investors to diversify and hedge against systemic risk, signaling that US-China tensions are no longer confined to trade alone. And speaking of the trade war, US President Donald Trump has indicated that he may eventually lower tariffs on Chinese imports, acknowledging that current duties, some as high as 145% and higher, have severely disrupted trade between the world's two largest economies. Quote, "At some point, I'm going to lower them," end quote, Trump said in a televised interview on NBC's Meet the Press, adding that China is eager to resume commercial ties. Quote, "You could never do business with them otherwise," end quote. Since Trump announced sweeping tariffs last month, China has responded with retaliatory duties of up to 125% on US goods. As we saw in the last episode, however, it seems that a fifth to a quarter of these have been quietly scaled back. The tit-for-tat measures have rattled global markets and pushed up prices for everything from manufacturing inputs to consumer staples like clothing and toys. Trump's comments come as signs of economic strain emerge from China. The country's Manufacturing Purchasing Managers Index shows factory activity contracting at its fastest pace since 2023. Export orders have also plunged to levels not seen since the peak of the pandemic lockdowns. Despite rising tensions, there are glimmers of diplomacy. China's Commerce Ministry said on Friday that it's elevating the possibility of reopening trade talks with the US, helping lift US stock markets. Trump, however, said Sunday that he had no immediate plans to speak with Chinese leader China Xi Jinping, stressing instead the need for a, quote, fair deal, end quote. Meanwhile, Chinese exporters are increasingly turning to loopholes to bypass tariffs. A growing number are using origin washing tactics, routing goods through third countries and falsifying their origins to avoid detection. South Korea's customs agency recently uncovered $21 million worth of misdeclared goods, primarily from China and destined for the United States. At the same time, Chinese e-commerce giant Temu is halting direct shipments from China to US customers. Facing the end of the de minimis customs exemption and new 120% tariffs on small parcels, Temu will now fulfill orders from US-based sellers. The shift could significantly shrink its US operations and signals broader disruption for low-cost retailers like Shein, who also relied on the exemption to flood the American market with cheap goods. With back-channel talks beginning and workarounds multiplying, the future of US-China trade remains uncertain, but far from dormant. And of course, the trade war is just one part of the wider US-China Cold War. The United States of America is currently making sure that its national security isn't compromised. There are many moving parts, from trade to the dollar, as well as materials, the bedrock of the economy. Without them, the US will find it hard to compete with China. That's why the current administration has signed several historic executive orders to protect copper production and mining on US soil. Copper is often called the new oil. Copper demand is surging while supply struggles to keep pace, and all this while Washington is working to bring US copper production back home. Global mine production is expected to peak in 2026 with a projected 700,000 ton deficit in 2025 alone. Underinvestment in new mines has caused a supply crunch, and a US-China trade war has disrupted global copper supply chains. The world is hungry for copper, and this means big opportunities for savvy investors seeking to take advantage of this historic shift. And today's video sponsor, Giant Mining, provides such an opportunity. Giant Mining Corp, ticker symbol BFGFF, not only operates a copper-silver-gold project in Nevada, but also recorded its best ever drill intercepts in September of 2024. The company is the North American copper company to be watching. On February 14th, Executive Order 14213 was issued and implicitly prioritizes copper as a critical resource. Nevada, where Giant Mining's copper project is situated, has consistently ranked among the top mining jurisdictions in the world, which is why this company is being brought to your attention. Giant Mining's balance sheet is now fully funded for its drilling programs in 2025. Giant Mining is well positioned to accelerate its exploration efforts and potentially capitalize on emerging copper market opportunities. This is great news. The share price is down by 50% since early February due to all the market turmoil, so it could well be in a very underpriced position. Giant Mining owns the Mabuta Hill Copper Project, a past producing mine. In the past 4 years, management and the company's geologists have actually expanded the copper deposit, and this past September, Giant Mining had their best ever drill hole. Historic underground mines in the project produced copper, tin and silver from the early 1900s to the 1950s, including 2.8 million pounds of copper, 184,000 ounces of silver, 5,800 ounces of gold and 21,000 pounds of tin. Well below its all-time high, a mining-friendly administration, copper coming back to America, and a serious asset in Nevada. This is a speculative play, high risk, but also a potential very high upside. As such, Giant Mining is worth considering due diligence on for any savvy investor seeking to take advantage of the historic changes we are seeing in the world today. Do your due diligence. A big thank you to Giant Mining for sponsoring today's episode. We now return to regular content. And finally for today, over the weekend, US-based The Wall Street Journal published an excellent article titled, "How Bad is China's Economy? The Data Needed to Answer is Vanishing." We end today's video by unpacking some of the salient points made by the authors in this article. Until recently, researchers, investors and analysts could access a broad array of official statistics from China, helping them track everything from the property market to consumer sentiment. But in recent years, Chinese authorities have systematically withdrawn hundreds of key economic indicators, leaving the global community struggling to assess the true health of the world's second largest economy. Along with missing data are figures on land sales, foreign investment, unemployment, and even soy sauce production. The government has also stopped releasing statistics on cremations, an especially sensitive metric following the country's zero COVID exit, and discontinued a once standard business confidence index. While no official explanation has been given in most cases, the data blackout coincides with an era of economic turmoil in China, marked by collapsing property markets, declining youth employment, and persistent trade tensions with the US. Analysts suggest that omissions are part of broader efforts by the Chinese Communist Party to control the economic narrative as the country faces rising internal and external pressures. Key metrics that once provided insights into economic stress are now no longer available. For instance, national land sales, a major source of local government revenue, saw their value fall 48% in 2028. The data series was discontinued at the start of 2023. In parallel, youth unemployment data, which reached a record 21.3% in 2023, was suspended altogether. When a new data set was introduced 5 months later, the revised rate dropped to 14.9, largely due to the exclusion of millions of full-time students from the labour force count, a decision widely questioned by economists. These changes have forced economists to rely on unorthodox proxies to estimate economic performance, box office revenues, satellite imagery, and nighttime lighting. Cement production and electricity generation have all become stand-ins for official GDP metrics. Researchers now scrape social media posts and location data from private firms like Baidu to assess retail activity and job market conditions. One economist said he tracked closures of gyms and beauty salons reported in local news as a proxy for the health of the services sector. Official GDP figures have long been met with skepticism. In 2007, former Premier Li Keqiang famously referred to GDP numbers as man-made and instead focused on electricity usage, freight volumes, and loan disbursements to judge economic vitality. That legacy of doubt persists. In 2024, China reported a GDP growth rate of 5%, perfectly aligning with its government-set target. However, independent assessments suggested actual growth was significantly lower. Goldman Sachs estimated a more realistic growth rate of 3.7%, while the Rodian Group pegged it at just 2.4%. A top economist from SDIC Securities controversially claimed growth might have been closer to 2%, remarks that led to his silencing by authorities. The data gaps are undermining investor confidence at a critical time. In early 2024, amid mounting economic anxiety, foreign investors pulled more than $2 billion out of China's equity markets in just 2 weeks. Shortly after, the Shanghai and Shenzhen exchanges halted the release of real-time trading data on foreign inflows and outflows, further clouding transparency. Access to existing data is also becoming more difficult. A 2021 law restricted many types of information, such as corporate registries and satellite images, to users inside mainland China. Foreign analysts and banks now face significant hurdles, with some resorting to regular visits to cities like Shenzhen just to download key statistics. The party appears especially sensitive to data involving its most vulnerable sectors. The property crisis is a prime example. When the Baker Research Institute revealed in 2022 that housing vacancy rates in 28 Chinese cities were unusually high, hinting at a massive oversupply, the report was swiftly retracted. Analysts believe government pressure played a role. Other metrics have disappeared without clear rationale. A number of the new stock market investors, toll road operators, and year-end debt balances, and even the volume of soy sauce produced have all gone dark. Perhaps most notably, the number of cremations, an indirect measure of COVID-19 deaths, was removed from public data sets after the end of the zero-COVID policy, despite estimates suggesting up to 2.1 million pandemic-related fatalities. Some data sets have returned sporadically, like the publication of school toilet sizes earlier this year, but these are the exceptions. In contrast, data may hint at demographic decline or fiscal fragility, like tuberculosis vaccine distribution or detailed birth statistics remain unavailable or unreliable. As China navigates an increasingly complex economic landscape and confronts intensifying global scrutiny, the growing opacity of its statistical apparatus represents not just a policy choice, but a broader strategic stance. For analysts and investors alike, the message is clear. Beijing is tightening the flow of information just when the world needs it most. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I will see you for the next episode in a few days.